Hey everyone, talking about short-term patterns this time. Now short-term is relative to the time frame, so it's really talking about looking at individual bars and patterns between just small bars, one bar to the previous one, sometimes up to 3 or 4 bars, but never much beyond that. So we're going to talk about some gaps, some bar patterns, little tiny bar patterns, and some candlestick patterns in this session. So it should be a fairly quick one. This content is common between CMT1, CMT2. You're expected to know the same knowledge. So if you're doing CMT2 and you really grasped it well, you probably don't need to go through this, but we'll go through this material fairly fast. And you've got the notes and a review at the end of it as well. So first slide here, gaps. Gaps, they occur when the low of a bar is greater than the high of the previous bar, or the high of the current bar is less than the low of the previous bar. And so you get this gap happening. Typically, they'll happen in equities and things where there is a long gap between trading sessions. So you've got an equity that closes at 4 o'clock on one day, doesn't open till 9 o'clock the next morning. In those hours in between, maybe there was a massive news event of some description which has a big effect on the share price. Often earnings announcements will be happening outside market hours, and so you get these gaps that are happening. Usually there's some sort of event that results in that, and so everybody agrees that the price has shifted, and so it'll gap up on the open the next morning. Some gaps are meaningful, some aren't. Typically when you have a indice that runs 24 hours a day, or is indices are an average of a whole lot of individual equities, you don't normally see gaps. Occasionally around some really big events you can see them, but again, typically not usual, and partly because the calculation for the open doesn't usually change. It hasn't usually absorbed all the new opens of the individual equities at that point either. Usually we're expecting gaps to be accompanied with high volume. Okay, let's jump on to the next slide. All right, when we talk about gaps being filled, what we're talking about is the price. So let me get my pointer across. So we have our gap here, and then the price data fills that gap. So it's filling in within probably a short period of time. We're expecting that gap to get filled. I mean, every gap, or most gaps, get filled eventually, but we talk about it being filled when it happens fairly quickly to the gap, or in a shorter period of time after the gap. I don't necessarily agree with this third point here, and this is sometimes where, we've got to teach you the material of what's written. It doesn't really make a lot of sense to me, but what they're basically saying is after a gap occurs, you should wait to see if it gets filled. I mean, that's fine. And as I said, we're only talking about 3 or 4 days. So we should be waiting to see if it didn't get filled, then it would be, yes, this is a really strong signal of the market heading off in this case, an upwards direction. I would actually be more inclined to say, when a gap happens, you take it as a signal and you put your stop underneath the gap, because a gap getting filled is telling you that no, we're dealing with an exhaustion gap more than a runaway, and we'll explain all those in a moment. But interesting for the exam, they would say wait for it to see if it gets filled. All right, breakaway gaps. Now these typically happen at the start of a move. So we've had a downward trend, we've got some indecision going on, and then suddenly we get a breakaway. And even from a candle perspective, you can see that we're dealing with a really strong upward candle after the breakaway gap, which will be again another great confirmation of what's going on. Usually these happen out of some sort of consolidation, out of some sort of pattern, Remember, we just did bar chart patterns. We talked about our support and resistance lines, and then we get a gap out. Gaps out of patterns are great indicators for our breakouts. The size of the gap is proportional to the price move. The bigger the gap, the bigger the move you can expect out of that. There's no real measuring technique that we use in relation to that. It's more of a comparison thing when you're looking at a chart that's had several gaps in the past. Opening gaps is a variation of gap. Now, what's happening in this case? Let me get my pointer across here. We've had a bar. Let's take this inside bar, or this lower bar here, and then we get our open down here of the next day. Now, we would call that a gap because the open gap down, but then within that day's session, the gap got filled. So it's an opening gap, but it's a filled opening gap. So these aren't immediately obvious, but it does fit that criteria of a gap that's been filled. And here we have another example again. We have a lower bar here. We're opening outside the range of this bar. And so that's an opening gap, but then it gets filled within the day session. You would expect the opening gap to be filled within the first 30 minutes of the trading session. If it doesn't, then it's highly likely that that gap is going to hold and that we've got a gap, in this case, to the downside. This is another case of why intraday data can be really handy when you're looking for little pieces of confirmation like this. We often say to a lot of our clients that you do your analysis on the end of day basis. And you look at the trends, you're trying to find the primary trend to trade with the primary trend, and you would only look at intraday data as a way of confirming or finding entry points, etc. You're not really to do the bigger term analysis. All right, so runaway gaps is the next one we have here. Now these often happen in the middle of the trend, and usually in a strong trend. So the trend's been established, then some piece of news or some large fund has decided to jump on board as well, and they're pushing the price up and we get this gap overnight. Very similar to flags and pennants, we talked about those last time, where we can use them as a measuring guide. And we'll explain that. Well, let me just explain it now. Basically, when we measure, we go from the low before the gap. So we take this major trend up, or this trend up, and we measure to the middle. Now, it's really important. I've got a little cutaway here. Really important that we're measuring to the middle of the gap. If you're doing any of the practice exams, there was a question, but it wasn't measuring to the middle. You do need to make sure that you do that with your calculations. And then from that, we can project up. We just take that same distance and project up, and we get to the top. I think mine may have moved slightly by 0.008, but nevertheless, you can see that that target there was reached very easily. These seem to work about 60% of the time. So when you get a gap like this, you can measure and have 60% assurance that it's going to get to that point. Exhaustion gap is the next one here. This usually happens at the end of a move, and it looks like a runaway, and when it first happens, you're not really sure whether it's exhaustion or runaway, but typically it's going to get filled within a few days to a week, and then you know that, yep, that was an exhaustion gap. And so, typically this is the latecomers coming in. The news stories have gone out about how great, what is this, Apple, how great Apple is, and everyone's jumping on board. But this is that period of distribution from a Dow perspective where we're expecting, the smart money to be distributing out their shareholdings to the latecomers. So when you look at this chart of Apple, you see all three of them. So we can come down here and we've got right at the start of the trend is our breakaway gap, giving us a really clear idea. We've been in a downtrend coming into November 2011. We hit this period where we're starting. Looks like we're heading for a double bottom. Didn't make it, got a breakaway gap here, and that's a really clear indication that we are now in a confirmed uptrend. Keep going, and then we get this this measuring gap in the middle. And we can use that as a target, and that's what we've done here. We've set a target, market's just stormed up, touched it on the high there, you know, and kept going. Had another measuring gap here. We could use that as well, and this is the one that I used earlier, where I went from the low to here, and we got basically the top of the market. So you could use that as well. You know, another target, less likely, would be to even take the low of the whole move. You know, you can do that, and then you have another target off in the distance. Yeah, whether that, obviously that didn't happen. Although I probably need to have a look at a chart and see whether it eventually got there or not. And finally, in this same move, we got the exhaustion gap at the end, and then the price had closed out within the 2 weeks. And so we knew it was the exhaustion gap and the end of the run up there. So a couple of examples there, some other common gaps that you will see or hear about, but there's really no statistical significance to them. You know, a small gap, it's a tiny gap. You know, you're expecting these gaps to be a significant size. If there's something that's trading in cents and it's only like a 1 cent gap, you know, not really very significant. Ex-dividend gaps, when ex-dividends are announced or a stock goes ex-dividend, you're expecting the prices to be adjusted, and there can be gaps in for that. Suspension gaps, even on futures or commodities where there may be a day session and a night session. The time period, there's usually like half an hour to an hour between sessions. If there's a gap in that time, it's called a suspension gap. Again, it's just not, we don't really look at that one as much as we do the overnight gaps on equities and things like that. It's just a short pause in trading, that's all. All right, so a couple of bar patterns. Again, we're calling it bar patterns. Don't confuse it with the other section, which is the bigger, longer term bar patterns. These are more just very short term patterns of bars and things like that that we watch out for. So the first one is spikes or large bars. These are high volatility days. You know, in reality, when we look at a bar like this, if we could see inside what happened that day, I mean, remembering that a one-day bar is made up of lots of price action during the day, there's probably gaps going on an intraday basis. We just don't see them because we only have an open high-low close on the chart. But, you know, as I said, there's usually gaps going to be going on. The other thing we notice about these spikes, and as I said, they're just really large bars, is really the point here. But the thing we notice is that we'll often see those towards the end of a trend. So if you're getting a trend and you're starting to see large bars, I mean, really what it's telling you is that the volatility is increasing. There's buying pressure and selling pressure, and there's battles going on, and they're starting to get into this period of uncertainty. And so they can be a really early warning that the change of trend is coming. That final point, spikes can often represent the start or end of a trend. Dead cat bounce sounds a little bit morbid. It's basically a short rally that follows a drastic fall in the market. So if you look at this case here, we've got this massive drop in the market, you know, very rapid compared to the rise up, and then we get this short rally, and that's what we call the dead cat bounce. I guess it's akin to dropping a cat out the window and being a bit of a bounce there. As I said, a little bit more, but I don't know who comes up with half this stuff. The rally's volume, so as we're getting this rally up here, the volume's going to be weak and probably declining. Huge indicator that what we're looking at here is a dead cat bounce and not any type of reversal. 81% of the time, when you have that condition of a rapid drop, declining volume on a rally, it's going to continue on down lower and make new lows. This final decline here, it's obviously not as intense as the first bounce, first drop here in the bounce there. Island reversal, really it's just a lone bar out on its own. Usually at the end of a long trend, you just don't want to be the people who have taken the wrong position and in this case sold short in that bar. But yeah, it's an interesting one. You're usually going to have gaps on either side of it. Pullbacks and throwbacks are common. So, you know, in this case, let me get that pointer. What we've got is we've had the gap down, we've gapped up, even gapped up again, and then we pull all the way back. So we've got a throwback down here to this level. And so, you know, so they're quite common, but failures are low. So 13 to 17%, remembering that 33% is our break even. Anything less is good. That's a failure rate break even. So 13 to 17% is nice numbers there to have on the island reversal. All right, one bar reversal. This is where what we're doing now is looking at the opens and the closes of these bars. So we've had a run up and your expectation would be that there was a number of bars coming up. We have a bar here, the high's greater than the previous high. Typically the low's greater than the previous low, but the close is lower than the previous open. And that we would call a reversal bar, and in this case a one bar reversal. A two bar reversal, it's the same as the one bar, but it's just spread over two bars. If you imagine that this bar could be split into two, it's really the same sort of pattern going on. We come up, we've got our open, we go higher, we've got another bar here. These don't necessarily have to be the same length, but you know, the tops do have to be around the same point. And then we close lower. This close is lower than the close here before we went into the two bar pattern. Also known as pipe formation. You may hear that as well. Again, just a reversal pattern to know. Horn pattern is exactly the same as the two bar pattern, but there's a small bar in between, so it becomes like a three bar reversal. Again, just something to keep in mind there. The two bar breakout rule. So here's a bit of a little trading strategy that some have used, where you're looking at this and you're saying today's low is lower than yesterday's low, today's high is lower, so it's a lower bar, lower high, lower top, lower bottom, and today's close is less than the open. If that's the case, we're going to buy when that high is taken out. So you're really waiting for the next bar. So in this case here, we've got our bar, we've confirmed that it's a lower top and a lower bottom, we've confirmed that the close is lower than the open, and now we're waiting for the next bar and to see whether we take out this top. And if we do, then we're going to take that signal. Now in this chart here, you can see these green arrows are where that would have happened. So take this case, we've got our lower bar there, lower top, lower bottom, the close is lower than the open, and at this point here, we took out that high and we would have taken an order. So you can see that there's some pretty ordinary signals there, but a really nice one here. That one would have been good. And quite often you can get that where you have a strategy that's giving maybe not so many signals, but when it does, you know, the returns are great. And so, but again, that's where you've got to use some intelligent testing and quantitative testing of your signals. And we'll talk more about that later. Inside bar. So we've defined these. Now this is a color scheme I'm using on this bar chart called swing relations. So if you grab Optuma, you can change the bars to swing relations and you'll see all these colors. Green is higher bars, where it has a higher top and a higher bottom. Blue is an outside bar, which we'll talk about in a moment, where it has a lower bottom but a higher top, and so it completely engulfs the previous bar. Red are lower bars, and then black ones are inside bars here. And so that means that the high and the low are completely encompassed by the previous bar. And really what it's reflecting is a pause in trend, you know, in a pattern sense. It's like a real mini triangle going on as we go on. Some, you know, results there, you know, buying if the next open is above the inside, selling if the next open is below the inside close. So you look at this close here on the inside bar. In this case, the open was below, so we would sell. Not so sure how it would have worked in this instance, but they're the rules that they have written in the book there for this one. Outside bar again, as we said, higher top, lower bottom. Closing near the extremes of the outside bar. Really strong indication that it's going to continue on. Now, this is a fairly non-committal case. The green bar after it, if that was an outside bar with the close right at the top, that would have been a great indication. High rate of failure on that. You know, these aren't really the best necessarily trading signals to use, but you do need to be aware of them. A high probability setup outside of from an outside bar is that we look for a close below the previous low. So we've got an outside bar, but the close is below the previous low. The next bar opens even lower again, and then you buy the following day. So we set that up on this chart here. You can see the couple of signals. It's a lot less signals, but in this case, these are actually pretty good signals. And I'm not going fishing, looking for charts to give you the best signals. It's really, I just think of a code, apply it, and there it is. You know, I'm not going to make technical analysis look like it wins all the time. And so, you know, to throw this on and get a couple of really nice results like that so quickly is quite impressive there. But of course, everything needs to be tested before you would implement anything in your own strategies there. This one I did put into our signal tester. If you go to optuma.com/videos or optuma.com/proweb, did a lot of webinars on signal testing, statistical analysis of signals. And so that's what I'm using here. And you can see the results that I'm getting on this one. Essentially, this strategy across the S&P 500 equities would return on average 1% per month, which isn't too shabby, 54% probability of gain. And so that leads to about a 10.5% yearly gain. And that's if you just did this strategy, nothing else as your buy signal. So quite interesting. Other short-term patterns to keep in mind, trend correction. Basically they're really saying is just wait for the first correction. We've talked about this before in identifying the primary trend. We always know there's going to be some sort of retracement, so we're waiting for that and wait for the first correction before we would enter on that. Oops was an idea developed by Larry Williams, and it's really, again, when the bar opens outside the previous bar's range, it's like that opening gap. We talked about the opening gaps and the opening gaps getting filled. Well, Larry Williams would basically say, it's almost like the market goes, oops, didn't mean for that to happen, and come back. And so when he saw that type of event, he would have an order just on the low, just above the low. And so when the price goes back inside the range of the previous bar, the order's triggered, and there's some nice short-term trade there. Shark is a 3-bar pattern where you have a tall bar followed by 2 inside bars. So again, think of a triangle, an isosceles triangle, or symmetrical triangle, I should say. And that's what you've got happening here. You know, this first one, you know, we based it on an outside bar, probably not the best example. This one's great though. You have this long bar, then we get an inside, then we get another inside, and we're just looking for a break. And we get a break of that because the base of the triangle is exceeded, the base being here, and we would have been in. Now again, questionable whether that would have been a good trade or not. Remembering we talked already about volatilities and long tall bars being really an indication that there's a lot of volatility going on in that security. Inside bars are low volatility. We're not really seeing, we're seeing a decrease in volatility as that's happening. Wide range bars usually found on a breakout. So again, these big bars are found on breakouts. Sometimes if there was a really big bar, you could think about it as a gap, and just sort of use that sort of mindset of, hey, there could be a gap inside this, and have the same sort of concept. So if you saw a really large bar in the middle of the run, well, you could measure from the middle of the bar as well and use a measuring objective. Usually, at panic lows, you're going to see those type of big, tall bars as well. And again, narrow range bars, the inside bars, it's really just waiting for a breakout. All the same principles that we talked about in bar chart patterns, where we talked about the triangles and the consensus and just people waiting to see what happens to the price. All right, so that takes us into candlestick patterns, which is the next section here, dealing with a number of patterns. Now remember, we talked about this in the charting module. They're essentially a form of bar chart where we're showing the open and the close and the high and the low. A couple of different things. Filled candles are the ones that are going down. I like to think of them as solid, full of lead, and so they're heavy and they're falling, whereas the open hollow candles are, they have the close at the top. Again, think of them as light balloons and they're rising up. If the package that you're using uses different colors like red or green, that's no good. That's just so hard to work with. You really, to do candlestick analysis, you have to have just basically the black and white. Are they solid or are they hollow? And that's what you need to be able to see there. Developed in Japan, mid-1600s, by rice futures traders, and then all these patterns came out of that. So, we introduced the patterns earlier. We're going to focus on some particular patterns. Now, often these patterns come in pairs, but sometimes they have different names depending on whether they happen at a top or they happen at a bottom. You're going to have to remember all of these. We've got a nice little chart at the end to give you a guide. Again, stick it up on the wall and make sure you've been able to memorize all of these. In all of these images, we're going to have black, obviously, for solid and white for hollow. If it's a grey body, that's just saying it doesn't matter. As far as the pattern goes, it doesn't matter whether it's solid or hollow. And so you'll see that as we go. All right, so let's go to the doji. Now, in this case, you can see I've done them all grey. Whether it's solid or hollow doesn't matter, doesn't change what this pattern is. So this is a 1 bar candle. Often you see this at the end of moves, and usually it can signal a change in trend is about to happen. It's a possible reversal. The doji is a very small body. Remember, the body is the distance between the open and the close. We call that the body. The lines up and below, beneath, are either they're called the shadow or the whiskers. But in this case with a doji, we're looking for a fairly narrow range or a small body, and usually that body is around the middle is what we want to see there as well. All right, so spinning top is the next one we've got here. Very similar to the doji, but it's just got a larger body, is the only difference there. And there's proportions on when does it become, a spinning top's about 1/3 of the height between the low to the high there. And that would be the demarcation between doji and spinning top. All right, hanging man, hammer and hanging man. This is one of those cases where it's the same candle, but it's called different things at tops and at bottoms. So at a top of a market, it'd be called a hanging man. and at the bottom of a market, it would be called a hammer. Hammers always happen at the bottom. So that's one thing if you can try and remember that. Out of the single candles, it's rated fairly high as giving an early indication of a change in trend. You would expect the lower wick here to be at least 2 to 3 times the size of the body for it to be a proper hammer. All right, shooting star and inverted. So this is the opposite case. Again, at the peak, it's called a shooting star. And at the trough or at the bottom, you're going to be called an inverted hammer. So remember, the hammers are all at the bottom of the markets. Again, 2 to 3 times, same sort of principles there apply. In candlestick terminology, we have what we call a window, which is essentially just a gap. All the same things that we talked earlier about gaps apply here. You know, you can do your measuring, everything like that. Everything else is the same. But it's called a window, and windows can be filled or closed or left open. All right, so two candle patterns. So now we've got the harami, which is a large candle, and then the second candle is inside the range of the first one. So it's very similar to an inside bar, but where it's a little bit different is when we talk about inside bars, we talk about lower tops and higher bottoms, whereas in candles, we're just looking at the bodies. So we're looking at the body of the second candle to be within the range of the first candle. And so it's always the open and close whenever we're doing candlestick analysis like this. And you can see that just on that second case there, you know, we've just got the dotted lines, which is show. Doesn't matter what the shadows here do, or the whiskers, but it does matter about the body there. All right, engulfing. So again, it's a 2 candle pattern. It's the opposite of harami. Really what's happening here is that we've got a body which is completely engulfing the previous body that we had. And this one is a little bit different. So you often see this happening at the end of a major trend, or you know, the start of a move down or a move up. And so we've got bearish engulfing, which means that we've had white hollow bar candles going up, and then we get this dark solid candle going down. So that's going to be our bearish engulfing pattern. And obviously the opposite there, on a down market, we've had downward candles, and then we get a white candle that completely engulfs the previous candle, and that's going to be a really good signal of a change of trend going up. That's the theory. The testing that Bowalski's done says that it's not rated so well, but definitely one that's worth knowing about and seeing. The signal gets better the smaller that first candle is, and then the bigger the engulfing candle is. So they're ones there. Dark cover. So it's got a hollow body here. So this only happens at tops. It's more like a continuation pattern. So we've got the, it's a bullish reversal pattern. So we've got the hollow body here. The market's been going up. And then we get our dark body here. So if you think about it, we closed here, we gapped up to the open, may even have gone up first, and then the market's come down and we've gone into the body. We're expecting this close to be in the body of this one. And that's when it's called a dark cloud cover. It's got to be well within. If it went too far, it would be an engulfing pattern like we had before. So, you know, before we had this one here where we closed, we opened, but then it kept going past. So, you know, we're not talking about an engulfing. This one's a dark cloud cover, and it stops inside the body of the previous candle. Now, the opposite case to that is the piercing line. Same sort of thing though, where we're going down, the market's going down, we've closed at the bottom, we've opened lower, gone down a bit with that shadow, but then turned around during that day and started putting in new highs, closing within the body of the first candle. Same sort of thing. If it penetrated too far, it would be engulfing. All right, morning and evening star. So now we're getting into 3 candle patterns that you need to know about. So this, again, usually happens at tops and bottoms. It's the middle candle that's the star. It can either be hollow or filled, but typically what we're looking for here is that body to be completely almost on its own. Doesn't matter if the wicks or the shadows are overlapping it, it's those bodies again. We want that body to be clear. Can be a star, can be a doji. A doji can be a star, but it's a fairly small candle compared to the other ones. It's actually one of the better performing candle patterns to watch out for, but there's one better which we'll show you in a moment. So yeah, keep an eye out on that one. 3 black crows, 3 white soldiers. So going down at the top of the market, you can get these 3 black solid candles. And then also at the bottom of a market, you can start to see these 3 white soldiers, a great indicator of a change in trend. The problem is that by the time this has been identified and confirmed, most of the move is over, especially if it's a short-term move. So very hard to sort of test this, but definitely something, again, to keep in mind. You'll need to be able to identify these patterns as well. You want to see long bodies on these. You don't want to see short ones. These should be fairly long compared to the average body length around that period in the chart. They should be fairly long, so there's a lot of conviction in those moves. This one is the best pattern that we've seen in candles. Typically, again, happens at the end of a trend. So in this scenario, we've gone up, we've had a really strong candle again, closing high. And then we've had a harami in here, where we've got this inside candle, could have closed either side, but then our final candle opens within the body of the harami and then closes down outside the range. So this would be a 3 inside down. And then here's the 3 inside up. So the market's come down. We've had our harami. We open on the final bar inside the body of the harami and then go up where the closing outside the range of both those bodies. So this is ranked as one of the best patterns. Once you see this, it's a strong confirmation of a change of trend, and you can continue on with that. 3 outside up, 3 outside down is a variant of that. Again, well, it's a variant. It starts with the engulfing pattern and then continues. So, again, we've gone up into this point at the top of a market. We suddenly get our engulfing down. We've tried to open higher again the next day, but the bears have pushed it down again. And the opposite for the bottom bullish variant. So there's 3 outside up, 3 outside down. The third candle, it's a large body candle that breaks beyond the close of the second, is really important. It's got to break beyond that one. What we've got here is a little cheat sheet that you can print out and keep on hand. Again, between now and the exam, just review these. Make sure you memorized all of these because you need to know them. And then that's it for the short-term patterns, the gaps, the little bar chart patterns, the candlestick patterns. These are the types of things that you need to know. You need to be able to recognize those 3 types of patterns. Opening gaps, you may not see so much about them, but worth just knowing that it can get filled immediately in that day. You really need to know about the volatility, what low bars, short bars versus long bars. What does that mean from a volatility perspective? And then be able to describe and identify all of those different candlestick patterns. So that's it for short-term patterns. Thanks for watching.